Snap-on stock, ticker symbol SNA. This stock is up 4.6% on the year-to-date chart, while the overall market, in this case the S&P 500, is up 8.2%. So that's a big difference to start with. Snap-on beat on EPS and revenue, and for the upcoming years, analysts expect that Snap-on will report another beat. On the 20th of April they will present their new quarterly results, so I'm looking forward to these numbers. From a dividend point of view, things look pretty interesting, with dividend yield sitting at 2.7% and the 5-year growth rate at almost 15%. But does this mean that Snap-on stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Snap-on do. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, comparison versus some major competitors, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Snap-on do? Snap-on is an American designer, manufacturer and marketer of high-end tools and equipment for professional use in the transportation industry, including the automotive, heavy-duty, equipment marine, aviation and railroad industries. When we check the most recent earnings report, we see that net sales was reported at 1.15 billion, which is an increase of 4.3% year over year. Gross profit was reported at 560 million, or 48.5%, which is up a tiny bit versus last year. Operating earnings was reported at 311 million, or 25.1%, which is roughly the same as last year. Diluted EPS was reported at $4.42, up 7.8% year over year, which is very nice. Snap-on has 4 segments, of which Snap and Tools is the biggest, representing 38% of the total revenue. Repair systems represents 30% and commercial and industrial is sitting at 26%. Financial services is the smallest segment with 6%. Starting with the biggest segment, Snap-on Tools. Sales are up 7.5%, but the gross profit and operating earnings have decreased a tiny bit. Nothing to worry about for now, but you want to keep an eye on this number. The second biggest segment, Repair Systems, is up 11.6%, which is very nice. Gross profit decreased a small amount, but so did the operating expenses. Bottom line operating earnings increased 50 bps to 25.3%, which is higher than the average margin, so that's something I really like. The third biggest segment is commercial and industrial, which is down 4.3% in sales year over year. It has to be said that currency had a big impact here, since organic sales is nearly flat year over year. Gross profit increased, but bottom line operating earnings stayed flat, so this is definitely a segment to keep your eye on, especially since the operating margin is significantly lower than the overall margin. The last segment is financial services, reporting a 1.6% increase in revenue. Nothing to mention here for now. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Snap-on is a 12 billion market cap company. PE ratio is at 13, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for Snap-on, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 4.49 billion, and in this graph we see that revenue went up quite nice and steady over a longer period of time. During the lockdown periods revenue was down a bit, which doesn't worry me a bit as well. Margins are going up in the long run as well, which is also something that I really like. To me this comforts me a lot. They are capable of growing the revenue, but with increasing the margins they are increasing the net income at a higher pace. EPS is also going up in the long run and also looks really steady and consistent, which I really like. Price to sales ratio is at 2.89 right now. Over a longer period of time it's increasing. The current number does look not that great to me, and also keep an eye on the increase. Price to book ratio is pretty much the same story. Price to free cash flow does look good to me. It's around the 20 mark, and it has been there for a longer period of time. Analysts expect EPS to increase at the low to mid single digits, which looks pretty decent to me. It's a slow growing company, and that's also reflected in the revenue expectations. Analysts expect to see a low single digit revenue growth in the coming years. Return on assets is sitting at 10.7%, which is above my 10% minimum. Return on equity looks also really good. And the most important number, return on invested capital, is sitting at 12.4%, which is a really good number. Another thing that I really like is the fact that it's above the 5-year average of 12%, so they are doing a great job here. Current ratio is at 3.47, which is something that I don't like. It's way too high and I prefer a number below 1.5 here, so definitely keep an eye on this number. Total debt is sitting at 1.27 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at almost 757 million, so they can pay down a big chunk of their debt, which is something that I really like, so this does look good to me. Nevertheless, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and a lot of things. And in here we see that free cash flow is going up in the long run. However, most recently it decreased a bit, so keep an eye on this number as well. And another thing that I love about this company are the shares outstanding. It's going down in the long run. It means when the shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2.7%, which is a decent number. Annual payout is at $6.48 and payout ratio is at only 35%. I prefer 50% or lower, so right now they have roughly 65% left in cash to buy back shares, pay down debt, acquisitions, research and development and all other things. The 5-year growth rate is at almost 15%, which is really good. On top of that, they grew the dividends for 13 years in a row, which is also pretty impressive. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare Snap-on stock with the overall market, in this case the S&P 500. Next to that I added Stanley Black & Decker, ticker symbol SWK. On the 5-year chart we see that Snap-on returned 85%, beating the S&P 500 big time, and crushed the returns of Stanley Black & Decker, which returned minus 42%. On the 1-year chart it looks pretty interesting as well. Snap-on returned 16%, beating the S&P 500 again, and Stanley Black & Decker had a minus 41% return. On the 6-month chart it's again Snap-on that had one of the highest returns, only this time the S&P 500 did slightly better. On the 1-month chart it's the S&P 500 that's the winner again, while Snap-on returned minus 0.34%. So bottom line, Snap-on did beat the S&P 500 in the long run, and also crushed Stanley Black & Decker. But how about some fundamentals compared to the other company? We see that these two companies are quite similar in market cap, but not in enterprise value and employees. Snap-on has a 14 PE ratio while Stanley Black & Decker is sitting at 87. Revenue growth year over year is the highest at WK, and so is the 5-year compound annual growth rate. But with the net income compound annual growth rate, we see that Snap-on is the winner. Last but not least is the free cash flow compound annual growth rate. Snap-on is again the winner here. Snap-on has the highest gross profit margin and the highest net income margin. On top of that, they also have the highest free cash flow margin. Return on equity, return on assets and return on capital is also the highest at Snap-on, so they are the big winner here. The cash to debt ratio is also looking way better at Snap-on, so again the winner. The last thing that I want to check are the dividends. Dividend yield is the highest at Stanley Black & Decker, but so is the payout ratio, which is not a good thing. Dividend growth is the highest at Snap-on, but SWK has the most consecutive years of dividend increases. Overall, I think Snap-on looks like the better company, but is Snap-on stock still a buy at current numbers? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 2%, 3% and 4%, since I think they will increase their revenue at the same numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 20, 21 and 22%, and for the free cash flow margin I'm filling in 16, 17 and 18%. For the PE ratio and the price to free cash flow I'm filling in 15, 16 and 17, since I think we shouldn't overpay for the slow growing revenue. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Snap-on stock is at $239. I hit analyze, and we only see one green number. We have a low price target of $155 to $193, which is a big drop from where they are right now. We have a mid price target of $182 to $225, and we have a high price target of $214 to $262. To me, the high price target is the most justified here, since I expect the company will increase their margins and free cash flow margin as well in the coming years. Revenue growth will be around 3 to 4%. Based on this price target, we have a range of $214 to $262, showing that it's within the middle of this range. My final conclusion on this stock is that I do like the company a lot. It's a slow growing company with great fundamentals, low debt and increasing margins. Dividends are looking great and they are capable of increasing the dividends at a high pace. For now, the valuation doesn't seem too interesting, so the best thing that could happen is that with the next earnings the stock goes down big time. The price target is showing a fair value of $214 to $262, so with a margin of safety I'm hoping to hop in at $180. For now I will analyzing this company from time to time and add them to my watch list. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.